Now we're going to start the in-class demo questions for Chapter 5. And I'm starting with in-class demo question 5-1. I've put the question up on your screen right now, or up on my screen right now, but note that I'm not going to keep it there. You have to have your own copy and follow along as I solve this problem. Notice that we have credit terms right here, and they're different than the one from the previous video. And we have shipping terms, which means that this is on account. Merchandising companies have more complex accounting because, why do they have complex accounting? Because they both buy and sell inventory. And because they buy inventory, they're a buyer and it's an accounts payable. But when they sell inventory, they're the seller and it's an accounts receivable because they have a legal right to collect cash from their customers. Because of those things, it's far more complex to record merchandising operations than it was in Chapter 3 when you were dealing with a service operation. In addition, the financial statements are a little bit more complex, so you have to keep in mind that this is going to impact your concept of Chapter 4 financial statements. Let's get started. I'm going to take this off. Remember to have your own copy to follow along with, and what we're going to do is we're going to fill in the chart. Notice that this chart does not have account names. That's because you have to come up with the account names, not the question. So now I've got it so everybody can see it. Let's get started. So we'll read the blurb to begin with. During April, the following transactions occurred for Hauling Inc., a wholesaler that sells clothing to other retailers. Record each of the transactions into the expanded accounting equation using account names. So we've got our first transaction. It's on April 1st. Purchase inventory from Roberts Inc. Terms 210, net 30, FOB, shipping point, $7,900. What did the company get? They got inventory, which has future economic benefit, so it's an asset. I'm going to add in the word inventory here, short form. So that's what they got, inventory, $7,900. What did they give away? Well, they gave away an IOU, a promise to their supplier to pay them in the future. And an IOU to the supplier is an accounts payable. So we're going to put AP over here, short form for accounts payable, $7,900. Notice that the equal sign is working perfectly. Notice that we didn't use cash because there's shipping terms. And as soon as there is shipping terms, sorry, I just said shipping terms. Notice we didn't use cash because there are credit terms. And as soon as there are credit terms, we know that it is a non-cash transaction. It has an accounts payable or an accounts receivable. Accounts payable when we are the buyer, accounts receivable when we are the seller. In this case, we're the buyer, it's an accounts payable. Let's move on to the next transaction. April 3rd. Oh, I'm going to turn on the light here. Does that help? Yeah, it does. Sorry about that. April 3rd. The appropriate party paid shipping costs on the purchase from Roberts Inc. $120. Well, what is the shipping terms? The shipping terms are FOB shipping point. So for FOB shipping point, who is responsible for paying for the freight? And the answer is the receiver. And we are the receiver, so we are responsible for paying for the freight. When we pay for the freight for inventory that we're receiving, sorry, I think I just slurred those words. When we pay for the freight for inventory that we are receiving, we have to record it as part of inventory because freight costs make our inventory more expensive. So what did we get? We got additional value to add into our inventory account. That would be $120. What did we give away? Well, it says the word paid, so that indicates we gave away cash. Negative $120. And note that I use brackets to indicate negative. So we're good with that one. Let's move on to the next one, April 7th. Returned inventory that was the wrong color to Roberts Inc., $1,000. What did we get? We got back our IOU because we no longer owe Roberts anything at all. So we got back our IOU, negative $1,000 to the accounts payable. What did we give away? Well, we gave back the inventory. We don't have inventory that has future economic benefit anymore. So we have to reduce our inventory account by $1,000. Let's move on to the next entry. Paid Roberts Inc. for the outstanding amount, April 11th. When we do this calculation, as you know, because you already watched the video on credit terms, we have to do a 3-step process that I think is really valuable to learn. So let's go through the 3-step process. Step 1. I'm just going to make sure, yeah, you can see it. Step 1. The first step is we have to ask ourselves, what is the amount of the accounts payable or accounts receivable? Accounts payable when we're the buyer, or accounts receivable when we're the seller. In this case, we're the buyer. So we're going to look at the following. We're going to look at the original purchase, and we're going to deduct any returns. Because if it's returned, we don't owe anybody anything. That is going to be equal to the amount of either the accounts payable or the accounts receivable. In this case, we're doing accounts payable, so accounts payable. Original invoice was original invoice was $7,900. The return was $1,000. So therefore, the accounts payable balance right now is $6,900. That's step 1. Let's move on to step 2. In step 2, we determine the amount of cash that is actually going to be transferred. Nope, I'm wrong. In step 2, we determine whether they are falling within the discount period. Because if they're not within the discount period, we're going to have to pay the full $6,900. So now we ask ourselves, is this within the discount period? And so we have to do that calculation. We have to look at the original date. In this case, that original date was April 1st. Then we look at the terms. And these terms were 2/10. So we had 10 days. And if we add those two together, it will tell us on what date we actually have to make the payment in order to take the discount. So that's 10/11. So we've got until April 11th, midnight. And what's the date today? It's April 11th. So we can take the discount, which is excellent. Now, step 3, how much cash? We've got to figure that out. So let's look at this. We take the AP amount, and that's from step number 1. We're going to multiply it by 100% minus the discount. That's going to tell us how much cash we've got to pay. So in this case, the AP amount, which is from 1, $6,900, multiply it by 100% minus the discount. If you look at the question, it tells you the discount is 2%, minus 2%. And that is going to be, wait, I need an equal sign. That is going to be equal to 6,900 multiplied by 98%. And that is going to be equal to, wait for it, I've got my calculator out here. 69. That is equal to $6,762. Now we have to look at what is the amount of the discount. So this is the amount of cash, discount. We're going to take the original AP amount and we're going to subtract the cash amount. And am I low? Oh, I got to move the page up. AP amount is 6,900. Cash amount is 6,762. So what's the discount amount? The discount amount is $138. So $138 is the amount of the discount. So now we've got to reflect that into the records. Let's move my calculator. All right, what did the company get? They got back their IOU for the amount of the accounts payable, which was $6,900. We know that because of our calculations. So negative $6,900. What did they give away? They gave away a cold, hard cash. But the amount of cash they gave away was not $6,900. Instead, they only gave away $6,762. Where does the difference go? The discount. Well, when you think about it, you paid less for your inventory. So your inventory isn't valued the same anymore. It's cheaper because you got a discount. So in that case, the discount goes against the inventory, reducing the value of the inventory by $138. If you look at this, negative 6,900 is equal to, add these two numbers together, you get negative 6,900. So our equal sign still works. So this is perfect. Let's go on to the next entry. Now it says April 13th. Purchase inventory from Nikki Inc. for cash. Shipping terms are FOB destination, and it is $920. What did the company get? $920 of inventory. What did they give away? Cold hard cash, negative $920. It says the shipping terms were FOB destination. April 16th. The appropriate party paid shipping costs on the purchase from Nikki Inc. of $15, but it's FOB destination. So who is responsible under FOB destination? Wait, let me just find my, where is my shipping term little sheet? I don't know what I did with it. Ah, here it is. Here it is. Let's just quickly look. It is FOB destination. FOB destination, who's responsible? The shipper. Who are we? We're the receiver. So therefore, we don't have to pay anything. The answer is no entry. Perfect. Next, April 18th. Received a cash refund from Nikki Sports for a return. The return was due to inventory that was damaged in transit, $110. So what did we get? Well, we got cash because they gave us money, right? Because we paid originally in cash, they're giving us cash back. We got $110 back. What did we give away? Well, we gave away the damaged inventory because the damaged inventory isn't worth anything to us. So we gave away the damaged inventory. Inventory reduces by $110. I'm going to pause the video here. I'm going to stop the video here, and I'm going to continue in the next video.